Okay, guys, tax deductions are a huge thing in the investment world. And believe it or not, people can either forget about it or they can have it wrong, which can leave money on the table. So stay tuned. I've got a super professional leader, captain of the industry with me, Bradley Beer, that's going to take you through it this morning and tell you a little bit more about what you can do to get a bit more money in your back pocket. Bradley Beer from BMT Tax Depreciation. How are you, legend?
Good, Mark. Great to be here.
Thanks for coming in.
Look, always look forward to talking property depreciation.
You know, are you over it yet after 20, 30 years?
27 and a half years? Nah, I still love it. Talk to investors all day.
All day, every day. Now, just to put it, like, I guess, set the tone a little bit, we're with, in Australia, the biggest, literally, he's 7 foot tall, the largest tax depreciation company. You guys are well esteemed, well respected by accountants, by industry bodies out there doing what you do. So thank you so much for your time today and coming on and spending that time with me. And when we came in and had a chat with our team, but landlords out there and people that are buying properties at the moment have an opportunity where there's some serious money to be made. And I often think sometimes people got to have their priorities better done. They know what petrol prices are when they're up a cent or 10 cents and how that affects their back pocket. But sometimes if they're an investment property owner or they're intending to buy one, they don't have their head around these numbers.
And look, Mark, after 27 years, they're better than they were when I started, but there's still a lack of knowledge sometimes around what it is. And also that, out of the reports we did last year, the first year deduction is a $12,000 average. Like, wow. We're looking around for our dry cleaning and our things and our, arguing about 1% in property management fees that make not much difference in comparison to doing this properly and making sure you take advantage of it properly, because it just makes such a big difference to the cash flow.
It's a low-hanging fruit. Now, I've got a question for you. What is depreciation to an investor? Like, I know for you, you must laugh at this question. For me, I obviously have known what it is most of my working life, but there's people out there that don't know what it is. What is it?
Yeah, it's really, like, I think sometimes, Mark, the easiest way to explain it is just to think about a car, because then people get it really quickly.
Yep.
You drive the car out of the shop, it's new, it depreciates in value substantially. With an investment property, the building itself, the carpets, the things in it, they're wearing out, so they're declining in their value, I guess, and you're able to claim a deduction against that wear and tear. We do want the property to go up in value, which it does usually, but the actual building itself and the things in there are depreciating like your car does, and it is a deduction that you can make against any investment property.
Solid. Does an accountant look after depreciation?
Yes.
How does that work? Because often when I tell a landlord, I go, look, have you talked about depreciation? Have you considered depreciation? What are you depreciating? They're like, I don't know, my accountant's doing that.
Yeah, so we work alongside the accountants. I'm a quantity surveyor. I'm not an accountant. We are the specialist in depreciation that estimates the cost of the building and comes up with these numbers and gives these reports to accountants. We visit the house, we find everything there. We work out exactly how much we can claim, make it as much as possible, of course. And the tax office accepts those construction cost numbers because quantity surveyors do that traditionally as a job, as opposed to all of your tax return. We're like the ear specialist to the doctor that looks after your ear, I suppose, and gets that.
They need you.
Most of what we've done is recommended by the accountant, because the accountant goes, you need one of these, you go and get one from a quantity surveyor.
Okay. Now, a couple of years ago, there was some big reforms, maybe a bit longer than that, about new and old depreciation. Can you still get it on an older property depreciation?
Yeah, they've changed the rules a couple of times over the years.
Yeah.
Especially, it's nearly 10 years ago now. But look, new property costs the most and gets the most deductions. A comparable old property doesn't get as many deductions. But, there's a few rules as to why and how. But without going into detail, new property does get the most, but old property still gets some deductions, may not get as much, but it's always worth asking the question, regardless of the age, because renovations can change that, ages, and when you bought it, we'll have a look at it, see if we think there's deductions there. We'll only ever do something if we think there is deductions there. We've done the best part of 1 million of these things, so we should know whether there's something there before we go out and go through the whole exercise. Yeah, we're close to 1 million.
When you're talking to the team today, you have a guarantee on that as well. Like if you don't make back, when is that?
Yeah, twice. So if we have a look at it and we think it's worth it, and we should know, and we go out and we start, we get there and we realise there's not enough there. We guarantee that if we don't get twice our fee and deductions in the first full financial year, then you can walk away and pay nothing. So we just don't want the fear of call about the old property. Is it not worth it? And charge you something unless you're going to get some deductions for it.
Now, with renovations, you mentioned also there's a trick where you can cash out on some or cash in on cashing out of your renovations. So how does it work with renovations with depreciation?
Two things with renovations. The first thing is, the work that you do, there's more cost, there's more things there to depreciate, so you get to add them to the depreciation that you claim. The other, I suppose, almost the trick, if you want it, trick's probably not the right word, but the thing to make sure you take advantage of properly is if you rip it apart and you throw things away or scrap them, we use the word scrapping, you scrap stuff that still had some value left for depreciation, there's a potential instant deduction for whatever's left.
That's nuts.
I
feel so stupid about that because I've never told the landlord that. That's money for jam.
And it's not, and the depreciation's great, but it goes over years.
Yeah.
If you throw it away, it's like all throwing it away now.
Yeah, it's a steroid hit for them. It's great.
Steroid hit. And the important question is just get the coin surveyor to look at it first and make sure there's a depreciation schedule in place.
Nice. Now, with investors that have been missing out on depreciation, can they go back on missed deductions or is it too late?
Very important point. It's a bit like if you don't pay your tax, the tax office will find you eventually and make you pay it.
Yeah.
They'll probably give you a fine as well.
Yeah.
It works kind of the other way but only for 2 years. So if you've had a property,
it's different to the tax office finding you because they go back as long as they bloody. They only give you 2 years on depreciation. If you made the mistake, what?
It's not quite as good, but you can easily go back and amend 2 tax returns.
Right.
And if you could have claimed $10,000 and you didn't, or even if you just claimed $5,000 because it wasn't done properly, then you can actually go back and amend and claim the difference, and can mean some serious cash back in the investor's pocket. So even if you've owned it for 5 years or 7 years, you can't go back 7 years, but you can go back 2, and there might be deductions there, give an indication of what sort of might be there, and see if it's worth amending and getting some cash back from the tax office, unless you want to leave it there.
Solid. Guys, if you just tuned in, we're talking about tax depreciation and how you can actually cash in on that when it's out there. So tell me more. I want to know more about this. What's involved when you're doing the tax depreciation?
Look, it's a process. We try to make it simple. We first want to just ask some questions about your property. We'll talk about the age and what's in it, and just identify that there's some deductions there.
Yep.
And once we do that, we gain some further information. We then, very important to the process, we go out and visit it. We need to estimate the cost of it, find all the stuff and things in there that we can claim, bring that back, put together a report, fairly simple, give it to the accountant, get some tax deductions, get some more cash back.
So that's a cool process. Now, how can I find out? I've got a question here from someone who's just writing in at the moment. How can investors find out if they're getting a depreciation schedule, if getting a depreciation schedule is worthwhile?
Thanks,
Barry.
Very simple. We with the simpler address of the property, we can see, because it will have been sold or listed for rent, we can see a bit about it.
Yeah. And
we can have a look at that and go to you, based on what we can see and a couple of questions, we think your deduction should be roughly X, or a range based on the fact that we haven't done the whole job yet.
Yep.
And then we can identify, look, there's deductions or there's not, pretty easily from that. Is it worth it? Well, if you like deductions and there's enough of those, then should be worth it. So shouldn't cost you anything to work that out.
Pretty easy to do that. Now, a property manager organises a depreciation schedule. So this is great for people. You can actually be a little bit lazy if you want to. You can just ask your property manager to do it for you, and they don't charge you anything, because a property manager charges a percentage fee for service, looking after you for the month, the year. So stuff's included, and them organising the depreciation, their time doing that, that's included. You just buy the report. So how do you organise that with the property manager?
Look, talk to the property manager. We need some basic information about the property. We'll come back with a few more questions. We'll organise with the property manager access and all those sorts of things. We can get a fair bit of the information, when you've bought it, what you've paid for it, that we need. We want some detail about your renovations if you've done something. But we go and find the age of the property. We go and find a lot of the information. Once we've got the address, we can see what we can find, and we come back to the property manager or yourself what else we need.
Guys, there you go. Depreciation, Mr. Beer. Is there anything that we've missed?
Look, I think don't leave the money on the table. We've covered a fair few of the basics there. Just get it looked at and see if there's some dollars there. I just see so many investors in my time that are, I thought it was all, or I thought this. Stop thinking maybe and just ask the question. We'll tell you if there's nothing there.
Thank you for your time, legend.
Thanks, Mark. Great to be here.
It's an honour to have you here. It is, seriously. When he said I would come in and chat with the team, I was like, a legend. So I had to take this opportunity to bring you on air today, and I hope that's helped landlords out there and people out there. Even if you're considering buying an investment property, don't forget to whack an extra couple $100 a week into depreciation potentially. When you're doing your numbers, if you're buying something new in particular, it's a really, really good thing to consider, industrial, residential, whatever.
Absolutely. All types of properties, anything investments, usually got some deductions available.
Thanks for your time.
Thanks, Mark.
See you guys.